We're going to have a review of 2023 and a look ahead to next year. We have a trio of experts for you. I think they're all going to come on together. I hope they're all mic'd up and ready. So please welcome, collectively, Mark Edwards from BDO, Catherine Cockhill from Hotstats, and Jerome Wise from Amadeus. Big round of applause for all three of them. Thank you very much.
Okay, good morning everybody. It is a pleasure to be here at Hospace once again. I'm going to try very hard to keep to my time because I know there's even more expert views and more data coming up. I'm going to encourage you all to think through the data that we present and then come and challenge us throughout the day, even better if you want to challenge me over a glass of wine later, to see how your experiences are and how much of this resonates with you. So in terms of what I've been asked to look at, here we go. Just a bit of a state of the nation, and then those of you that have heard me before will know that I have these four key themes for the sector, primarily people, property, profit and purpose. Let's crack straight on. You might remember this graph which we presented post-COVID, which was really around trying to deal with a crisis situation and then moving into building resilience in the business and then into realising value. I think what we've probably seen is that that recovery period has been more lumpy than perhaps one might have imagined, with various parts of this graph stretching out. I am going to make a plea to every operator in the room now, which I'm hoping Kate Nichols won't hold against me. But I appreciate that campaigning means we want to use the word crisis. If we're trying to go against the government and say we need help for business rates or we need help for employment, etc., or even cost of living generally, we need to use the word crisis. But in this country, we tend to react massively to influences, particularly in the media. So every time we hear cost of living crisis, employment crisis, we begin to have an impact on people's reaction and their spend patterns, but also in terms of how they choose to find work and their employment choices, and also, of course, in investor sentiment and banking. So I'm going to encourage everybody to take all the positive messages that we heard from Harry earlier, and some of those from me now, and try and think forward in as positive a view as we can. Okay, so despite the word crisis being mentioned in the media more often than any other word, what we can see here from some research that CEBR did with us, and along with YouGov, is that actually in the last 6 months, 5 of those have had positive consumer sentiment. Now, it's not overly positive, I don't want to oversell it, but it is positive territory, and that might act as surprising given those headlines. If we look at what CEBR do for ASDA, the ASDA income tracker, which you may have seen, you'll see that there is some recovery in discretionary spend. Now, the challenge for the hospitality sector, of course, is even if that number is in absolute terms, so even if that number is trying to nudge back to pre-pandemic levels, it's not there yet, it's not forecast to be until the end of 24. Of course, the absolute cost of going out and spending money in stays is higher than it was 2 years ago or 3 years ago. So the actual incidence of visits are likely to decrease. As soon as we see volume decrease, it means we need to work that much harder to build from RevPAR to TrevPAR. So that's just a theme that we're going to continue seeing, I think, and you'll see the 24 year-on-year change is forecast to be negative. So there is some downside risk, without doubt. Now, in our own surveys, we look at sentiment and what might happen going forward, particularly in the sector. On the left-hand side, I'm going to have to look over here. It's so small down here, apologies. On the left-hand side, you can see consumer spend intention. This is what customers, or your customers, consumers are imagining doing. And you can see the positive trend, which is good news. Again, it's quite fragile, but it is good news. In terms of breaking this down by demographics, so age categories, you can see the Gen Z, Gen Z sentiment is the most positive. Whether they're the most challenged in terms of income threshold, that's another debate, but something to consider. And again, once those that have the higher earning category have the most positive sentiment, maybe not surprising. And we'll see that again on the right-hand side when you split by income threshold. So the most positive sentiment is for those that are better earning. This is a graph which has asked consumers, if you were going to spend less, what would you do? about that. So clearly the most significant reaction is go out less often. But there are some other themes that come in there, including the replicate the experience at home. And so there's a challenge to us all to make sure that we are offering an experience that people can't have at home. You can't simply replicate it, so you're offering something different. And the piece around offers and loyalty programs is quite complex, because actually offers, so that is a discounting rate, or you see it in casual dining, the offer piece, that can lead to some real challenges in terms of building back, and that's no surprise to anyone in the room. So that probably leads more to a loyalty piece, but of course people are more fickle than perhaps they've ever been before. We've built a very cynical culture in the UK especially, and so loyalty programs need to actually mean something to be able to engage with consumers. You will hear the detail on hospitality stats from hot stats from Catherine in a minute. So I've tried to look at something slightly different. This is the listed space, primarily restaurants and pubs. And you'll see that there is generally good news. So I want to continue my good news theme here in the sense that we have positive like-for-likes being reported consistently, which is great. There is a nightclub operator in there which has the most significant negative, perhaps not a surprise. Fuller's aren't on there but have just released their results, and they would be at the 10% mark as well. So positive news, and of course we've seen some M&A transaction activity as well, which is nice to see. If we drill down between that though, of course there's a relationship between price and volume, and that becomes critical in terms of managing challenges over the next 12 months. Our analysis of the movement is clear: the spend in the top category, the transaction volume in the bottom, and a real differentiation between bars and pubs and restaurants. And this might be interesting in terms of thinking about hotel spaces and how you use your spaces and who you're trying to appeal to. So just something to bear in mind. It's a pretty stark picture. Okay, so it won't act as any surprise, but the biggest theme of 23 that we have seen is the differentiation. And it isn't simply the differentiation that you see here on the chart, but we're seeing geographical differentiation. That's US, Europe, and UK, but even within the UK, in terms of income split and discretionary spend, and then how people spend, that is varied. One of the things you'll see in the pubs numbers actually is wet-led rather than food-led. It's beginning to see its own. And the most interesting stat that I heard the other day at a round table was there is one pub operator that is wet-led. There's now 53% transaction through cash. And there's a real move to view, certainly the lower end, that cash transactions are actually quite important because they enable people to budget and to understand more sensibly. So that's something that, I'll be honest, really surprised me, and I didn't see as a trend that will come back. But we are seeing some operators reintroduce cash takings because they feel that will improve their overall take. Okay, on to people. So I've mentioned my key message, which is if we use the word crisis, we're going to be less attractive as a sector. We'll see the overall number of jobs clearly recovered from the pandemic. Again, this comes from CEBR analysis along with ONS. This is the vacancy rate, which is beginning to fall, which is good. However, proportionately in our sector, it's still quite high. So if you look at the actual overall number of vacancies compared to the retail space, for example, it's about the same number of vacancies, but retail employs more people. So proportionately, it's more of a challenge for us. But again, geography becomes really important. And I guess the other thing just to be mindful of, and this is very tricky to analyse in reality because the services sector is quite broad, and so where should accommodation and food service sit? But it is below the service sector overall. Maybe that's okay. But the trend line, we suspect, is still going to remain challenging for our space. So and we see that obviously while it's calmed down from where it was in terms of rate growth, there will still be challenges, and that's something we need to be very aware of. Okay, I have stolen this from an excellent webinar that I attended with HVS and Bird & Bird, but it makes the point very clearly. Initially, the point they were making was just to highlight, and this is June 22, obviously there's been another interest rate rise since then, but if you had a hotel, 50 million, with a debt sliced at 25 million and your EBITDA was 3 million, then the change in interest rate alone changes your interest cover ratio. That isn't a surprise per se. They're obviously warning that you need to engage with the bank and tell them what's happening. But the piece I want to pick up is that surplus cash is your reinvestment funds. That's what you're going to spend on your property. And inevitably, we saw it in any challenging environment, the first thing that is easy to consider cutting back on is the CapEx spend. But we're definitely seeing in the pub space that those positive numbers where they're coming out are often linked to CapEx projects. And already been mentioned, the new supply coming into the market. So there's definitely going to be a need to be mindful of the CapEx requirement that you're going to have and how clearly your free cash is going to be limited to do that. So it's going to be really careful, or you have to be very careful how you allocate cash spend. So the purpose, the fundamentals, they really haven't changed. You need a great product, you need great service, in a great location, providing great value for money. No surprises, I should be a consultant. Okay, we need clarity of concept. It is going to be harder to provide that because your demographics and your variation in terms of spend are becoming more complex, and we're going to have to get used to the idea that actually your consumer base is more complex than it probably ever has been before. Customization is demanded across the entire spectrum of age and income category, so the ability to customize whatever you're offering. The value for money is so important, it comes up again. As always, this is not simply about providing the lowest price offer, but this is so that someone walks away saying they have had value for money. And then earning every penny, and this I think is a theme that will come up again, which is what we have seen in the hospitality sector is a good year, really good year last year, which started again okay this year, which means generally we thought rate should hold, budgets were set with rate holding and occupancy increasing, the assumption being that TrevPAR should then increase. Again, we're seeing variations and a bit of a challenge on that in terms of that overall spend. And so I just have to tell you that every customer you have in the building, you need to try and get as much out of them as possible because that is going to be the cheapest way to maximise your return. Like I say, I would welcome any conversation in the bar later, but for now I will hand over to Catherine. Thank you very much.
Good morning, and thank you very much for inviting me here, Jane, to give you an update, a little bit longer than I had this time last year, when I think we only had a few minutes each. So we're going to crack on, because Hotstats has really made me understand, perhaps more than any role that I've ever had, when I was perhaps working for Hilton, for example, for whom data is huge, how important the right kind of data is. And there's so much of it, and it can become quite overwhelming and sometimes hard to know exactly where the really important elements of are and what's just noise that distracts. It's all about what's happening for hotels and what that might mean for 2024. But just before I go into that, just to give you a bit of background, we collect data now from over 11,500 hotels globally. That's up. In 2018, we had about 3,000 hotels. So it's a huge change, and that pandemic period has really made everybody help to understand what the importance of data really is. We map that data, hotels contribute that on a monthly basis, and that's what gives the benchmarking opportunities, but it also gives us the real live data to share with you today. So historically, our industry has been very good at focusing on rooms revenue, where it comes from, how to target it, but we've been less good at what makes the data, what makes us profitable. And we see a focus shift just from rooms revenue, how to control and understand the cost structures in conjunction with those revenue drivers that are so important, which enable best performance. And we are starting to get a little bit of traction there, quite a lot of traction. IHG in the Middle East, for example, have changed their metrics from RGI to PGI, so that's Profit Generated Index, and that's what they're basing their bonus structures on, which is a very exciting move. Hilton RMCC globally have now been given access to all of the benchmarking for their hotels. They're taking responsibility for that, and that's a really big change so that they can see exactly what's happening across all segments within their properties. So let's have a look at UK performance to date and focus on some of those headwinds that we've all been experiencing. So we've got some key cities here in this matrix slide. The TRevPAR percentage change versus GOP change, and that margin change is versus 2019. The vertical value is the GOP change, and we've got 4 quadrants. I won't go into all of them in detail because we obviously have a lack of time, but for those with a higher GOP margin than 2019, in the top left corner, there's nobody here, but that would be those with a lower top-line revenue and would be a great flex story. So they've managed to do more with less revenue than they were expecting, and it demonstrates that ability to make those cost savings and improve performance, even with perhaps a revenue shortfall. Bottom left, Madrid, Berlin, really struggling versus 2019 for both revenue and conversion. Nobody really wants to be in this part of the metric versus 2019. And cost management and budgeting is going to be very, very important to help flex that cost structure for 2024. Bottom right indicates perhaps a struggle to control the cost areas. Vienna, Manchester, Bristol all sitting in this area. And then top right, which is where everybody wants to be in terms of performance, with Paris sitting out there and Rome as well. If we look at the same cities now versus last year, we see a much better picture, real recovery with all of those green dots showing positive revenue growths and showing some very good conversion with well-controlled costs. London, Vienna, Amsterdam, all moving into this area and in the right direction. We still have Berlin and Budapest with some revenue shortfalls and perhaps not managing to flex their cost base as well as they might. And Dublin in particular seems to have gone backwards and dropped below that positive GOP line. Looking now at a month-by-month view of RevPAR, revenue per available room, development for the UK as a whole. The highlighted 14% is September, or was September 2022, and shows all revenue areas well recovered versus that same time last year. Even conference and banqueting is just peeping over the 1% positive edge versus minus 1% same time last year, and all of that bodes well for next year. Looking at occupancy now for the UK by asset class rather than the index, so that you can see the trend over the last few years. And the story is very clear. All classes exceeding that August-September 2022 position. Extended stay in particular I pull out because that seems to have done very well with increased exposure to new travellers who may not have experienced that type of accommodation in the past and prior to the pandemic, and perhaps fell in love with all of the space and the flexibility that it's offered them. We see a slightly different occupancy picture when we drill down into the city by city view, and I'm going to show you that when we get to that data slide. So UK ADR, or average daily accommodation rate, and we see all ADRs growing. It's something that we've been watching carefully for the last 18 months or so, all except for government, which has actually declined versus 2019. But I just be clear, this is government direct business rather than government business that's come through a travel agent. The negotiated transient and tours segment, seeing big hikes in rates since 2019 and in fact even since last year. And this really kind of speaks to the clear commercial plan that appears to be emerging to continue to support that ADR growth from all segments, which of course is supporting the overall profitability. We will see the impact on mix as the traditionally lower rated business mix changes, and it all just underlines how much the ADR has supported profitability, because that cost creep is really driving back into the picture, and actually the cost creep's become a bit of a cost gallop. And if we look at the ADR by key segments for London first now, to break it down regionally, and you can very clearly see here what's driving the rate. Retail, seeing a little growth, which is encouraging, and that's hotel website or brand.com. The OTA segment, which sits in discount and therefore drives the cost of acquisition, is very high on the OTA segment and does always need some consideration. It should be a focus when you're looking at the cost elements of where that business is coming from. There could also be some pressure here as well from corporate demand, which probably we'll hear a bit more from Jerome in the next session. Having less access to those negotiated rates because the ADR that was being offered as part of the RFP season last year and probably this year has moved itself out of some of the pockets that the companies have got and are prepared to pay. Although, of course, we can't track the actual sources because we don't have access to channel data ourselves. But we do see a growth in the corporate rooms ADR, which could hint at an increased demand for more event and group business. And we'll see as we move through the provinces to see whether that growth is actually an increased demand opportunity or whether there's something else going on here. Looking at the provinces, here again, following the same pattern, albeit at lower rates, of course. But even here, retail is also seeing a little growth, which is encouraging, as this business, of course, offers the lowest cost of acquisition and offers the best in terms of relationships with your customers. That direct customer gives you the data that you need to analyse what's working and to offer some insight into how best to attract them as returners in the future. And we are seeing a significant growth in corporate ADRs as well, which is the group element of it, with 15% growth in this segment versus 2019 year to date. Now, looking at the actual revenue mix by key segment for London first, you can clearly see the negotiated element, that's the negotiated transient element, reduced significantly with a decline versus 2019 of 36%. So this is this impact that we're talking about here for the transient corporate business. Corporate, in terms of group rooms, has stayed almost entirely flat, and that puts the question of increased demand to bed, really, at least for London. It's possible that the rates impact on this segment has now really peaked and is really starting to impact, in some cases, where that business is going. I mean, it's interesting to see where this might have gone. And when we look at the provinces, we see a similar picture as far as negotiated transient goes, but with quite a different for the corporate, where there's a 47% growth in the mix, which doesn't appear to have been impacted by that 15% growth in the ADR that we saw a couple of slides ago. Clearly, this business is finding a place outside of London with perhaps easier access, possibly free parking, more accessible rates, and anecdotally at least, possibly an easier staffing situation for some. My favourite view, perhaps, of what's happening now with this occupancy revenue note and where we perhaps strike a note of caution for 2024. Hotels have, of course, been doing more with less, and the ADR has been there to carry it and to head off some of those economic wins that we're all experiencing. However, it's something we're keeping an eye on because with the potential softening of demand for those leisure elements, which we saw was so strong in 2022 and for this year, it's going to be very important to maintain that total revenue piece. And it's the costs which are creating that pressure on profitability, as well as the occupancy number reduction. ADR is a crucial element, part of this, in getting that balance right and in getting the puzzle to work, to come together properly for 2024. We're really going to have to focus on that mix so that, you know, with the potential softening, we are able to contain and to maintain our profitability picture. Too many P's. So let's have a look at some of the actual costs involved by city and looking at the total booking costs as a percentage of total revenue year to date. In all cities except perhaps Bristol and London, which are pretty much on par, the costs are being driven up and quite significantly in Birmingham and Edinburgh, for example, and that's partly due, of course, to the rise in ADR. And in the next slide, we can see how this is broken down so that you have some visibility of the costs in all the relevant segments. So this is just 2023 now. The orange is the total rooms cost. The bluey colour is the OTA commission element, and green is the grey is the travel agency commission. In the red circle at the bottom is the cost change versus 2019 over the same period. And this is something that often comes up with owners and with stakeholders and sets out the costs and their relative values per occupied room. So it's a big part of that decision-making process when you're looking at the mix. They all need to be taken into consideration and set against the overall profitability for any piece of business that the commercial team are planning to take. You've got to work out what's best for you and what impact it's going to have on your bottom line. And so to the labour question, looking at UK versus Europe, both regions still doing more with less people. It's especially interesting for the UK when we consider wage inflation and what hoteliers are having to pay to entice staff back into our industry. And then we look at the next slide, we're going to see where some of the biggest challenges lie in terms of those cost areas. So it's not only the people. Linen plus 34%. Credit card commission plus 22%. Housekeeping labour, a massive 66% increase. It's a huge on-cost for hotels and part of, by far, the biggest impact in cost growth. And we're seeing groups where the daily cleaning costs are being charged, or hotels are offering F&B vouchers in place of that daily clean. And what a guest expects in the room remains an interesting topic. Much has been stripped out to remain competitive, of course. This has to be monitored. Water, Nespresso machines, magazines, all of the amenities that we're used to having in our rooms. those have all come back now and are much higher costs in most cases. Of course, what the brand expects is also part of their differentiation, and they want all of these things to be available and to their guests as part of the brand promise. And the overall pressure to stick to that brand promise, of course, is not going away. I just mentioned other rooms expenses there because that's the rooms department's share of training expenses, decorating costs and equipment rental, things like ice machines, etc. An obvious area for reduction or complete eradication in the 2020 times, but all of these things are back with a vengeance as hoteliers can no longer put these things off. Then there's a percentage change for UK per available room in terms of revenue. The joy of golf has definitely not gone away. Golf clubs that people bought during that period when we were first allowed out to play. Here we can really see the impact. It's not changing. It's still a huge area of growth. And the outlet revenue per occupied room, as we've seen, the UK is struggling with demand, by that continuing gap in occupancy, of course, and perhaps also by the growth of on-property food delivery from outside sources. Anecdotally, this does seem to have become a bit of a thing. It's okay to call in Uber and Deliveroo and have food put it into your room. I've stayed in a couple of hotels recently, although not in the UK, where this was actually suggested to me as something I might like to consider if I didn't like what the hotels were offering. It's definitely something to think about how we want to help our guests spend their money on property when we're talking about the total revenue piece. It's really a question of whether we're offering the right thing. Maybe is it what the customer wants? Are we offering what the thing that the segment that we're trying to attract is? Do we have that available for them? I just mentioned attrition here because that's an interesting one post-pandemic as a growth area. This is revenue earned from groups and events not fulfilling their F&B or rooms contracts. And these contracts are being upheld in a way that they never really were prior to the pandemic. Hoteliers are holding organisers to those contracts in a way they might not have done in the past, and it's something we're seeing all over the world. It's a contract, should be held, but in the past you might have had that conversation with your agent around, well, I know you're going to bring me some more business next year, so maybe we'll let you off some of that. That is definitely not the case anymore. Just a quick look at utilities, because I'm out of time. This time last year, this was very much the elephant front and centre in the room, for the UK at least. That blue line that we can see, things have definitely settled down. And although we may never reach that previous low of 2019 at £4.69 per available room, at least the major crisis point of August last year at £11 seems to be a thing of the past. Although with what's going on in the Middle East, there is obviously continuous volatility there. Just a little snapshot here of what hoteliers have access to in terms of overall performance. I would just draw your attention to that bottom area. We have all of this increase in revenue, total revenue last year, 144 versus 122 the year before. Sorry, that's this year versus last year. So that's a change of 18.5%. However, we can see that in terms of the margins at the bottom, so what we're actually making from that, there is very, very little change. And if we look at this by asset class for the UK, despite all of those high ADRs and the revenue increases that we've seen, the overall profitability picture shows that struggle across all classes and gives us a clear picture of the current situation. The ADR, the revenue versus all of those costs, and actually we're not really any better off than we were. So that's a real balance to focus on for 2024. Thank you so much. If anybody wants to come and talk to us, we are here all day and all evening probably. Myself and Tim and also Mike Grove, our COO, he will also be here at some point today. So do come and chat to us, and thank you very much.
Thank you, Kathleen. So the third person to talk to you about data at the beginning of the day, this is tough for you. So I've got four slides that talk about data, and then I've got 4 or 5 slides that talk about some research that we've done into the future of the traveller and the traveller's demands, looking 10 years into the future. So a little bit looking 3 or 4 months into the future, and then something looking 10 years into the future. So all the data that we're sharing with you, and I appreciate there's been lots of different sort of data points and data sources, is coming from the Amadeus Demand 360 data, which is the most comprehensive data set of what's happening on property in the industry. It's PMS level data, 365 days in the future and 4 years historically. And we have somewhere around over 40,000 hotels providing that data globally, and over 1,000 hotels in the UK and Ireland. So looking at the UK and Ireland, from an occupancy perspective, looking over the next few months, we can see that occupancy compared to same time last year is across every month is positive to last year, business on the books. So that's a really good trend for us. And I think a number of people that I've spoken to have been cautious about what's going to happen in Q1 next year. But from an occupancy perspective, at least of what business is currently on the books, is looking positive compared to last year. So that provides, I think, a reason to be cheerful. Breaking the UK and Ireland down into some of the major markets here on the map, you can see this is looking at November and December combined data, and this data is all pulled from the 6th of November, so from last week, so it's pretty fresh. You can see that this is not that occupancy is not all sitting in London. It's broadly across the markets that we've pulled that data for. You can see a very positive trend. On the right-hand side of the screen there, we're pulling in some of the Amadeus schedule of air availability data, and we'll be looking in 2024 to enrich our hospitality BI data with airline source data as well. So you can see where that business is coming from. So no great surprise, but a third of that broadly is coming from the UK. Spain is always the next biggest market, but bear in mind that the majority of that traffic is UK travellers going to and from Spain, not necessarily travellers or Spanish people coming into the UK. The US remains very strong. It's softened a little bit in the last month, obviously, but still remains very strong. And to Kathleen's point about room servicing, a longer length of stay that the US guests provides is cheaper for us to service generally, and is a lot more attractive to us as hoteliers. So make sure that you're marketing and you're reaching out and you're driving demand from those markets. Now looking at segment mix and channel mix. If you focus on segment mix first of all, you can see that the segmentation is broadly similar to 2022. So no great changes. Discount segment is reduced from 34% down to 32%. And discount does not mean OTA. Discount is any packaged rate, advanced purchase, bed and breakfast, park and fly, etc., etc. Negotiated has increased from 14 to 15, so that corporate traveller business is coming up a little bit. And then the next big thing, I guess all of our best friend in the room, retail, has increased from 28 to 29%. So that transient traveller that's booking retail rates is still very, very strong. When we look at channel mix, again, largely similar to 2022. Obviously it moved around a lot in 2020 and 2021, but brand.com has increased from 26% to 27%. Direct has increased from 27 to 29%, and OTAs has decreased from 31 to 30%. So bear in mind that the data set that we're pulling involves all of the global brands who all have obviously very powerful loyalty programs and engines to drive that brand.com. So don't beat yourselves up too much if you're not getting 20% brand.com, but it just shows you what's possible if you have a very strong and robust loyalty program. Then looking at ADR, again across up until April, occupancy is great. We can see on the first slide that occupancy was strong. ADR is also strong. So looking back to 2019, 2020, 21, 22, you can see that for every month, apart from the March and April, ADR, business on the books ADR is outperforming same time last year. We think the reason there's a little bit of softening in March and April is the type of business that's being booked right now for 5-6 months in the future is probably more of that discounted and offer-based business. So that retail, negotiated corporate business, etc., wouldn't have been booked yet. So what does this tell us? What are the key takeaways? I wish I could see the slide. The key takeaways are that occupancy and ADR remains very strong. Make sure that you're marketing and you're reaching out and you're capturing the demand from those key source markets that are coming into your city where you're operating, so you can get your fair share. Be very strategic and careful and look at that future ADR trends and occupancy trends against your comp set and in your market, so you can adjust and react and change your future performance. Look at that data very, very closely because trends can change very quickly. We've all seen how quickly trends change. Looking back and seeing what happened a year ago is no longer really relevant in today's world where things change so dynamically and so fast. So now a little bit about the future. I'm going to whistle through these because time is not on my side. But we've conducted a survey with over 10,000 people across 15 countries to understand what they're looking for in 2033 in terms of travel. And we've broadly broken that down into four categories: the travel technologists, the excited experientialists, I can never say that, pioneering pathfinders, and the memory makers. So quickly, what excites them about the future is that travel will be quicker and travel will be easier. The ability to remember or retain the experience of those trips will probably be enhanced through better technology. They'll be able to travel in more environmentally friendly ways, and travel friction will be reduced. And there'll be different payment options, different ways that they can pay for their travel. Their concerns, cybersecurity, data storage, etc. Travel might become more unaffordable as sustainable travel. There might be this sort of green tax, if you like, on sustainability. And political instability might limit to the places where people will be able to travel. And what they're most interested in, what technologies they're most interested in, are different payment options, easier travel using biometrics, which will enhance the travel experience through airports, hopefully. I saw that this week there's the 100 mil ban is gone from City Airport, I think it is. And so all those sorts of things hopefully will make travel a more enjoyable experience. So what can you do as hoteliers to capitalize on this? You can start by using the insights. Understanding your guests is probably the most important thing you can do right now. Getting that first-party data, understanding what motivates them, what inspires them, what creates the reason for their travel, and then responding to that and creating that personalized relationship or personalized with the guest is really, really important. Understanding and embracing what sort of technologies you should be using to serve their needs and to suit their desires is also really important. Travelers or people in general are much more reliant on the way they buy things rather than who they buy things through. So I'm sure we've all gone some way down the line of buying something and it's too difficult to do it that way. I'll buy through a different channel or through a different method because it's more familiar. So making sure you've got the technology in place to reduce that travel friction and to make it easy for people to buy is really, really important. I'm just going to go to the final slide. The QR code has risen like a phoenix from the ashes after the pandemic. We all thought it was dead in the water, but here it is. Scan the QR code and you can get the full report for that. It's a very, very comprehensive report. So I'd encourage you to get that and download it. I'm here with Benoit, my colleague, and Sam throughout the day, so we'd be very happy to talk to you about any of this or anything else as we go on. Peter, over to you. Thank you.
Thank you to Mark, to Catherine and Jerome, and well done all three of you. Packed so much information into a limited time there. It's really fantastic. And for me, you've turned on its head a maxim that I had always believed before, which is that an optimist is somebody who doesn't have all the facts.